Welcome everybody. Welcome back to Financial Accounting. Purpose of this video is to review the answers to the first exam, and you all will get back your exam booklets on Tuesday. I'll do it at the end of class. My experience, if you get back to the beginning of class, people just focus on the exam. We do need to get into new material. So the way I graded it, they were 2 points for each of the 24 multiple choice questions, which would have given you a maximum of 48. And then each of the 4 problems was worth 13 points. So you'll see on your cover sheet there, the first page, you'll see the total number of multiple choice, and then added to that the number of points you earned for each of the 4 questions. I did notice a slight error in my original answer key. So a couple of you see a note where I added 2 points. That was because I originally marked your answer wrong, but it was correct. And it had to do with question 12. So any errors that had been made have been corrected. If you know of any other errors, including maybe I gave you too many points, let me know. All right, so here goes. So let's start with the multiple choice. The financial statement that presents a summary of revenue and expenses. That is, by definition, the income statement. And remember, as you answer these questions, they go in chronological order. So there were 4 chapters and there were 24 questions. So I took 6 from each chapter. So the first 6 relate to chapter 1. So answer to 1, that's the income statement. 2, which of the following is a role of accounting and business? All of those things are roles of accounting and business. So the answer there is B. A purchase of supplies on credit. Remember, the accounting equation is assets equals liabilities plus owner's equity. So when you look at a transaction, which is something that has an effect on the accounting equation, the effect here is to increase the asset account supplies and to increase the liability account, accounts payable. So you go looking for that in the answers. And yes, for the answer to 3 is therefore A. Notice little technique here is I think what the right answer is first, and then I go looking for it. Next one also has to do with the accounting equation. If the assets and liabilities of a company were 128 and 84 respectively, what was the owner's equity? Remember the accounting equation, assets equal liabilities plus owner's equity. So on the left-hand side, if you get assets of 28, and on the right-hand side, you get liabilities of 84, in order for that to balance, the difference is the owner's equity, which is 44,000. Remember, sometimes owner's equity is referred to as a residual number, meaning that if you converted all the non-cash assets to cash, and then you paid off your liabilities, what would be left for the owners? So the answer there is B, 44,000. 5, which of the following statements would be prepared second? Remember, we do the income statement first because we need to know what net income is to do the statement of owner's equity. And then we do the statement of owner's equity before we do the balance sheet because we need to know what the ending owner's equity is to put on the balance sheet. As far as the statement of cash flows, we just touch on that very briefly. You'll focus more on that in your future accounting career. So the main focus for accounting 1 is the income statement, followed by the statement of owner's equity, followed by the balance sheet. Statement of owner's equity is what is prepared second. Number 6, which of the following is the authoritative body in the U.S. for accounting principles? That is the Financial Accounting Standards Board. Now, these next questions relate to Chapter 2. Which of the following entries journalizes the receipt of cash for 2 months? Again, think of what the journal entry is first, then go looking for it. So if you receive income in advance from rent, that you've got an increase to cash, which is a debit, and it's unearned rent, so you've got to have some liability for that, for unearned rent. So that's the correct entry, and lo and behold, when I look for it, that's B. Number 8, the process of recording a transaction in a journal, that is called journalizing the transaction. Journalizing is the process of recording in the journal. Number 9, why do we do a trial balance? We do a trial balance just to show the debits equal the credits. So the answer there is D. Which of the following statements regarding liabilities is not true? Notice I underlined and bolded not true. So A, B, and C are true. D is not true because liabilities don't include accumulated depreciation. Accumulated depreciation is what we call a contra asset account, which is an asset account with a credit balance. 11, a client has a massage and asks the company bookkeeper to mail her the bill. The bookkeeper would make the following entry to journalize the invoice. So the record revenue not yet received, they were looking for a debit to accounts receivable and a credit to some type of revenue account. And that is exactly what D is, debit accounts receivable, credit fees earned. Next one has to do with horizontal analysis. And this is the one where I made a mistake in my original grading for some of you. Horizontal analysis means we put the 2 years side by side, so year 1 followed by year 2. We get the dollar difference, which in this case is a 165,000 down to 150,000. So you've actually got a decline there, 15,500. And you divide that by the number of the base year 1 was 165. If you take 15.5 and divide by 165, you get 0.094. So the horizontal change is a negative 15,500, and that is a percentage of 9.4%, which you see my calculation here. You see the answer there, D. Each of these chapters ends with some type of financial analysis. So here we did horizontal analysis. So that was those next questions 7 through 12 from chapter 2. Now we get to chapter 3, which had to do adjusting entries. And adjusting entries always include a balance sheet account and an income statement account. So the answer there is D. 14, services to customers on the last day of the month were not billed. What effect would this have on the balance sheet? Well, if you have revenue that was earned but not yet received, you're supposed to accrue it by debiting the account sheet, some type of receivable account, and crediting some type of revenue account. So if you forget to do that, then you're understating the assets, and you're also understating the owner's equity, because any revenue that we have is going to end up increasing owner's equity. So the correct answer there is B. 15, Smokey purchases a 1-year insurance policy for July 1st. The adjusting entry on December 31st is, well, if it's purchased on July 1st and it's a 1-year policy, July through December is 6 months, so half of that insurance has been used up. So it was originally recorded as prepaid. So the amount that's been used up is $1,800. So you debit insurance expense, credit prepaid insurance. 16, a magazine publisher receiving payment covering a 6-month magazine subscription. That's an example of an unearned revenue. So the magazine publisher received the 6-month subscription in advance, so they increase cash and they recognize the liability to provide magazines in the future. So the answer there is C. 17, using accrual accounting, revenues are recorded. When revenues are recorded when we perform the service, and we're not concerned about when the cash is received. So when a service has been performed or products have been delivered to customers without regard to when the cash is received. So on the accrual basis of accounting, revenue is recognized when it is earned, not when it is received. So the answer there is B. Accrued expense ordinarily reported on the balance sheet. Remember, every adjusting entry involves both an income statement account and a balance sheet account. So a good example of accrued expense would be when we debited salary expense and credit salaries payable. So accrued expenses were ordinarily listed on the balance sheet as liabilities. And think of the salary example as an example of that. Number 19, which of the following is not closed at the end of the fiscal year? All the temporary or nominal accounts, all revenue and expense accounts are closed. The balance sheet accounts, which are called the permanent accounts or the real accounts, are not closed. And the only balance sheet account you got there is C, prepaid insurance. The income statement will present revenues less expenses, and the order that we do is we do the largest expenses first. We just leave miscellaneous towards the end. So the answer there is A. 21, classified balance sheet would show what sections. So these are the sections of the classified balance sheet. So current assets would be property, would go current assets first, and then property, plant, and equipment. Looking for the asset subsections, and the 2 asset subsections that we've introduced so far would be the current assets and the property, plant, and equipment. So the answer is B. 22, Weston Company has current assets and current liabilities and net income and a whole bunch of stuff that you don't need there. They ask us what the working capital is. So the working capital is the current assets of $82,530 minus $72,120. Adam, this was the question you asked me during the exam. So it's $10,400. Working capital is current assets minus current liabilities. When you subtract them out, you get a $10,410. 23, not 231. What is the first account that should appear on the post-closing trial balance? Post-closing trial balance will include all the balance sheet accounts, so all the revenue and expense accounts have been closed out, and the first account, always in the general ledger, is cash. So the answer is C. And number 24, the accounting cycle prepares 3 trial balances. So remember the sequence is first you have the unadjusted trial balance, then you have the adjusted trial balance, and you have the post-closing. So the answer there is C. Now we get into the problems, and each of these little problems was worth 13 points. So what you had to do here is you simply had to indicate which of the, this was from chapter 2, whether it was normally had a debit balance or it had a credit balance. Notes payable as a liability normally has a credit. Mortgage payable as a liability normally has a credit. Jeff Weldon drawing, that's when the owner takes money out for personal use. That reduces capital, so that's a debit. Accounts receivable is an asset account, has a debit balance. Jeff Weldon, that's a little error in my answer key there, but I had it right when I did it on the exam. Jeff Warden capital should be a credit, not a D. Ignore that D. Should have a capital credit balance. So you see that there. 5, yeah, should be C. Rent revenue should have a credit balance. Unearned revenue, it's a liability credit balance. And utility expense and automobiles are all accounts with debit balances. So again, there's an answer, correct answer there for capital. Jeff Weldon capital should be a credit, so ignore that little D there. Number 26, I thought I was making this easy for you. You just had to come up with the journal entry here. And rather than writing up the journal entry, I just had you put in the numbers. So here's what your chart of accounts, and you had to indicate what was debit and what was credit. So purchase of supplies on cash should be a debit to supplies, the asset account, and a credit to cash, which is account number 1. Paid annual premiums on property and casualty insurance, that's a debit to prepaid insurance and a credit to cash. Receive cash from customers on account, that's an increase to cash, or debit to cash, which is account 1, and a reduction of the asset account receivable, which is 2. Paid creditors on account, that should be a reduction of accounts payable, account number 7, and a reduction of cash. And then receive cash from customers for service provided, that should be a debit to cash and a credit to fees earned. Now, what I noticed with some of you is you put more than one number in the box, which could happen, but it would have to be a compound transaction, which is a transaction that involved more than one account, and that was not the case in any of these transactions here. And every transaction has to have both a debit and a credit. So some of you are still fuzzy on journal entries. Every journal entry has to have both a debit, at least one debit, and at least one credit, and they have to balance. 27, here's where you had to do the adjusting entries. So the first one was to adjusting entry for accrued salaries. So they told us that it was a 10-day work week, and you have to figure out the amount of salaries per day was $645 per day. So based on when the period ended, you've actually got 6 days in there. So it's 6 days times 645. So a debit to wages expense and a credit to wages payable. Then in February, when it's paid, the full salary of $6,450 is paid. But a portion of that is the $387 we had actually accrued in the previous period. So full entry is a debit to wages expense for 4 days, a debit to wages payable for the 6 days you accrued on January 31st, and a credit to cash. Depreciation expense here, they gave you the depreciation for the year. They wanted it for 1 month, so it should have been 1/12 of that, or so 39,600 divided by 12. And notice depreciation expense is always a debit to the expense and a credit to accumulated depreciation. And then the last one, office supplies that were used up, it's the difference between the office supplies balance, which was 3,755, and the amount that was left over, which was 635. So the difference was the amount that was used up. Debit to supplies expense, credit to office supplies. And then the last one should have been pretty simple. We're looking for the closing entries of the salmon entries. And all we do here is we have 2 entries. First, we close out the revenue and expense accounts. And if the revenues are larger than the expenses, we got a credit to capital. If the expenses are larger than the revenues, you get a debit to capital, which was the case here. So the revenue account, which has a credit balance of 41.5, you debit it. And then all the expense accounts here are credited, as you can see. And there is a balance, the difference between them. The expenses were actually larger than the revenues, so you have actually a debit to capital. And then your second closing entry is to close out the drawing account, which has a debit balance of 13,250, and you close that out by debiting capital and crediting drawing. All right, so I hope you found that review useful. I would say that some of you did fine. Some of you did not do well. And, sometimes we learn as much from our mistakes and our failures as we have from our successes. So those of you who had success, continue to do what you're doing. Those you didn't do well, the way that the grade for the course is set up, it's 25% for each exam and 25% for the homework. So it's fairly easy to get a high grade on the homework. But some of you who didn't do well, I would say candidly, if you got a 50 or below, you probably ought to drop the course. If you got above 50, you probably can still, pass the course. You got to have a grade of at least 60, I believe. So between better grades on future homeworks, future exams and future homeworks, you should be fine. But those of you, anyone who got below 50, I mean, there's something, you got to ask yourself, am I ever going to catch up? Am I ever going to get this stuff? So my advice is have a talk to your advisor, and then maybe you might want to try accounting again. I'm not going to boot anyone out of the class, but if you get less than 50, I would think twice about I would think good and hard about maybe dropping the course and trying it again with a fresh start. Okay, so I hope you found that review useful, and we will see you at the Tuesday class. Be well, everybody. Enjoy the rest of the day, and I'll see you this afternoon. Bye-bye.